Hello everyone and welcome back to our lecture series on process planning and cost estimation. In this session, we will focus on standard time estimation and work through detailed problems to determine direct and indirect cost, including factory administrative and selling and distribution expenses. Let's jump into the calculations. So let's start with an industrial work study problem to estimate standard production time. Suppose that in a manufacturing process, the observed cycle time for a single operation is measured at exactly 0.75 minutes. The operator's performance rating factor is evaluated as 110%. Additionally, we are given three distinct allowances such as percentage of the normal time, a personal allowance of 3%, a relaxation allowance of 10%, and a process delay allowance of 2%. Let's calculate the final standard time. To solve this, we first find the normal time by adjusting our observed time with the performance rating factor. So normal time is equal to observed time into rating factor, that is equal to 0.75 into 110 divided by 100. Since it is given as percentage, we have to convert that into divide that by 100. So we get 0.825 minutes. Next, we combine our three allowances which equals to 15% in total and apply them directly to our normal time. So 3 plus 10 plus 2, that is equal to 15% into 0.825 minutes will give you 0.12375 minutes. Finally, we add the total allowances to our baseline normal time to arrive at our standard time. So adding this 0.825 with the total allowances, will get 0.948 minutes. So this is the standard time. This is how we have to calculate the standard time. Hope you understand this problem. We will move on to the next problem, cost ladder example problem. So now let's apply our structural cost ladder concept to a corporate financial data set for the year 2020-2021. Our goal is to calculate the prime cost, factory cost, production cost, total cost and final selling price per item from the ledger details provided on the slide. The data includes initial inventory stock values, new raw material purchases, direct labor cost, direct expenses, overheads and an exact production volume of 650 items. So note that our ending inventory stock leaves us with rupees 15,000 in material assets. So step 1 requires figuring out the exact value of the direct material consumed during the year. So we calculate this by taking our starting material stocks, adding new purchases and subtracting our remaining stock at the close of the period, okay, which gives 50,000. So 25,000 plus 40,000 minus 15,000 is equal to rupees 50,000. So direct material used is equal to 50,000. Now we can easily calculate the prime cost by aggregating our direct material cost, direct labor and direct expenses. So direct labor is given as rupees 14,000 and direct expenses given as rupees 1,000. So prime cost is equal to direct material, direct labor plus direct expenses, which comes to rupees 65,000. Now we can accumulate our cost step by step up the ladder. Adding factory overheads of rupees 9,750 to our prime cost gives the factory cost as rupees 74,750. Adding administrative expenses of rupees 6,500 gives a production cost of rupees 81,250. Adding selling and distribution expenses of rupees 3,250, we get the total cost as rupees 84,500. So to find the bulk selling price, management applies a 10% profit margin to our total cost. So selling price is equal to total cost plus profit which put together will get rupees 92,950. Now, to make these figures actionable to our sales team, we divide each total cost category by our total output volume of rupees 650. So this breakdown gives us a prime cost of 100 per item, a factory cost of rupees 115, production cost of rupees 125, and an ultimate total cost of rupees 130, and selling price of exactly rupees 143 per unit. Now we will move on to the next problem, that is percentage based costing problem. So let's look at a different pricing scenario where cost elements are defined as relative percentages of one another rather than fixed values. So in this problem we need to calculate the selling price per unit for a batch of 200 pieces. We are given a baseline direct material cost of rupees 8,000. From there labor is defined as 60% of the direct material cost, direct expenses as 5% of the direct labor cost, and factory expenses as 120% of the direct labor cost, and administrative expenses as 80% of the direct labor cost, sales and distribution expenses as 10% of the direct labor cost, and profit as 8% of total cost. So total number of pieces produced to be 200, which is already given in the problem. So since our direct material cost is rupees 8,000, we can derive the remaining elements step by step. Direct labor is 60% of the direct material cost. So 60% of 8,000 will be rupees 4,800, and direct expenses 5% of the direct material cost, sorry, the 5% of the direct labor cost, which gives us rupees 240. So prime cost is equal to direct material, direct labor, and direct expenses. We will get rupees 13,040, and factory expenses are 120% of the direct labor cost. So we will get rupees 5,760. Then administrative expenses of 80, which is 80% of the direct labor cost, will get 3,840. So sales and distribution expenses as 10% of the direct labor cost, which is rupees 480. So total cost is prime cost, factory expenses plus office expenses plus sales and distribution expenses, which put together will get rupees 23,120. And next, calculating our 8% profit target gives us 1,849.60 rupees. Adding this profit to our total cost gives a batch selling price of rupees 24,970. So dividing by our total production batch of rupees 200 pieces shows that the final selling price per unit is rupees 125. Okay, hope you understand this problem, which is direct substitution of all the data which is given in the as per the problem statement. Next we will move on to the final problem focused on profit and loss verification. A factory produces 1,000 high tensile fasteners per hour on a machine, on an automated machine. For this hourly run, material cost are rupees 375, labor cost is rupees 245, and indirect expenses rupees 80. The factory on cost is 150% of the total labor cost, and office on cost is 30% of the factory cost. If the selling price of each fastener is rupees 1 rupees 30 paise, calculate whether there is a loss or gain and by what amount. Okay, so let's aggregate our baseline values of the hourly run as 1,000 fasteners. For 1,000 fasteners, we start with our direct material cost rupees 375, labor cost as 245, and direct expenses are 80. The factory on cost will be 150% of the labor cost, which is equal to rupees 367.50, and factory cost is the direct material cost, the prime cost plus factory on cost will give you the factory cost, that is 375 plus direct material, direct labor plus direct expenses plus factory on cost will give you a sum of rupees 1067.50. Next, adding these 4 production values together as an initial factory cost of rupees 1067.50. From there we calculate our office overhead as 30% of this factory cost, which gives rupees 320.25. So now adding our office overhead to the factory cost gives a total cost of rupees 1387.75. For the hourly batch of 1000 fasteners, this means our actual cost to manufacture a single fastener is rupees 130. Because our fixed market selling price is 130 is lower than our actual production cost, the factory is running in a loss. So the loss per fastener is rupees 0.09. So for every hour of production or every 1000 units produced, the company incurs a net financial loss of rupees 90. So this indicates the management must step into optimize the processor or negotiate the raw material rates. So with this we are winding up this session. So thank you for your time, and I will see you all in the next